Good day and welcome to Curate Investments exhibiting our Investment Artist webinar. My name is Ali Simpkins and I'm delighted to be your host for today's webinar. We have an exciting session ahead, but before we begin, just a few housekeeping points. We have applied for CPD points for today's webinar. To ensure your attendance is verified, please watch the full session and provide your ID number in the CPD section on the platform. The webinar platform will remain open until the end of August 2026, allowing you to revisit the session and still qualify for your CPD points. Once the full webinar has been viewed, the platform will automatically issue your CPD certificate via email. During this webinar, we will explore all things bricks, bots, and bargains, uncovering opportunity across property, innovation, and value. Today's session features insights from three managers within the Curate range: Sesfikile Capital, Jennison, and Lyrical Asset Management. It's designed to give you direct insights into the thinking of our investment managers, how they uncover opportunities and identify businesses positioned to benefit from powerful long-term trends. We begin with Sesfikile Capital, investment manager of the Curate Momentum Flexible Property Fund. During our conversation, we will explore the global property landscape and discuss where the team is finding attractive opportunities across different sectors and geographies. Thereafter, Jennison, manager of the Curate Global Growth Equity Fund, will answer all of our burning questions about AI and share perspectives on the current wave of high-profile IPOs. Lyrical Asset Management, manager of the Curate Global Value Equity Fund, will round off the session by highlighting overlooked opportunities in global value investing, particularly within distribution businesses. As the session unfolds, please feel free to submit any questions via the Q&A function on the right-hand side of your screen. Our speakers will either address questions during the session or respond afterwards where appropriate. Without further ado, I'm delighted to be joined by Evan Jankelowitz and Naeem Tilley, portfolio managers at Sesfikile Capital, to discuss the global property market and share some insights on the current investment landscape. Evan and Naeem, welcome and thank you for joining me today. Evan, please could you set the scene for South African investors in terms of the broader opportunity set for global property investing, essentially answering why invest in global property?
Well, obviously as a starting point, diversification, because global property is very much unlike local property, and so too as a separate asset class is very much unlike global equities or global bonds. So setting the scene, really, it gives you a world of opportunity. Obviously the bias is towards the USA, and they've just got so many more sectors than we have available to us here, sectors that are very relevant and sectors that are not necessarily so cyclical or linked to the general economy or the global economy, such as healthcare, data centers, cell phone towers, and more underlying sectors that Naeem will touch on later as well. So you get that diversity not only by geography, but also by underlying sectors and themes.
Great, thanks, Evan. Naeem, which key themes or opportunities are currently offering the most value?
Okay, so Alia, there's two important themes I'd like to talk to today, and the first one is data centers. And I think most of us will agree that the amount of data we all use, whether it's Netflix or WhatsApp or even our just daily usage of data has increased. But more importantly, in the last few years, the emergence of AI has really taken the use of data centers on another level. If you look at the amount of capex that the large hyperscalers have announced over the last few years, so the likes of Alphabet or Google, Meta, Amazon, Microsoft, they are expected to spend this year alone $700 billion in capital expenditure and expanding the AI data centers throughout the year. That number is even expected to increase next year as they continue to spend in AI. So this is a leading theme. And at the same time, what's important is on the supply side of data centers, it is very difficult to actually put these data centers out, whether it's because of the limited amount of power. Remember, data centers are heavily dependent on power usage. So it's not easy to secure the power supply, or whether it's land availability. It is very difficult to roll out these data centers, and it has created a bit of a shortage of supply, fueling rental growth. So we're seeing strong demand come for data centers for at least the next few years. The other important theme I'd just like to touch on is the necessity-based real estate. And it is exactly that. It's real estate that benefits from the demand, really from people's needs. So in the US, which is the key market for us in this example, the demographic shift of baby boomers over the last few years has really made demand for senior housing in the healthcare sector quite strong. And the big driver here is that baby boomers are, as a percentage of the population, is the second largest set in terms of population size, but is expected to grow by 5% over the next few years. So that demand for senior housing and skilled nursing facilities will remain very strong. And similarly to data centers, the amount of supply for these units are quite short. Remember, during COVID, a lot of the senior housing facilities, the construction starts or the new buildings actually came to a halt because there was a lot of uncertainty among how much of what's the demand going to be for these units going forward. And so with the supply having come to a stop then, and now we're not seeing a lot of that supply come to the market, the senior housing or the healthcare sector is benefiting from it. Look, the supply side will respond, I think, in time. But for the next few years, we're looking for net property income growth of double digits, 15 to 20% in most cases. And that's why the stocks continue to do exceptionally well.
Thank you, Naeem. Maybe to expand on that, what is the one area where the market may be misunderstanding the opportunities or risks within the global property markets?
I can go first there. So in my opinion, I think the rise of AI and the benefit we saw on the data centers, the flip or the other side of the coin of that argument is what happens to demand for office space. So as yet, we haven't seen a massive impact on the office market, but I do think it's a risk that we are facing. Now, with AI, a lot of the administration type of jobs, the finance and legal, and some low-skilled jobs could and will be replaced over time, and hence demand for office space around these type of jobs will start to dry up. We are seeing some impact of it in PPO markets, in like the likes of Poland and some other smaller markets. I think South Africa, and I know the question is around global, but I think South Africa is a little more immune to it in the short term. And I say that because our market, the labor force is generally quite cheap. Our office rentals are much cheaper. So a lot of these large global BPO companies continue to support our local market by relocating their services here, but it is a threat to both our local and the offshore office markets.
From my side, I see greening as a huge opportunity. Naeem spoke about certain aspects where office may not be in play, not from a work from home perspective, but more so from the risk that AI will take many jobs. But I do see that supply as a whole will come under pressure because building these infrastructures, these big buildings is not so green as such. And I do believe that there'll be a lot less supply across the board going forward. And, as Mark Twain once said, buy land now, they're not making any more of it. Similarly, with the scarcity of some of these assets. So I do think that, once you've got an asset that yields, and at the moment, especially in the retail front, for me, I actually like retail. Why is that? I think it's been unloved. Coming through COVID, it was really beaten down. It has bounced back a bit. But I think what it proved is that it has to work together with the likes of online trading or online retailing, as well as the fact that people are social beings. They want to be seen, they want to see, they want to touch and feel. So they want to be together. So I do think that the scarcity that will eventually arrive coming through in the retail space will be something that people misunderstand and that they take it for granted, as well as the fact that you can get some of these assets or some of these companies at quite attractive yields. So in the US, Simon Group just bought, so it's Macerich, just bought an asset. They call it the high single digits. And the amazing thing is that bond yields, even in these inflated levels, is about 4.5%, and they bought an asset around about 9%. Now that's still a very attractive yield. So you still get a nice carry, you have the scarcity value, and I believe you'll get growth in the long term. So I think that the benefits of greening will come at the expense of new supply coming through. And I do think, some of the key assets will see some upward movement in value.
I agree. Now, how do we see the current inflation outlook influencing the performance of global property over the next 12 to 24 months?
It's a great question, but obviously inflation these days, or let's call it the geopolitical state of the world, is very much in flux. So yes, we're currently living in an inflated inflation environment driven by energy prices, and it's really started out during the Ukrainian-Russian conflict, and it's really passed through into the crisis in the Strait of Hormuz. But the truth of the matter is inflation is negative from an opportunity cost in the short term. And why is that? Because high inflation leads to higher interest rates. And with the property companies not necessarily able to react on their actual, to call it rental levels they charge, you generally get higher rates as a higher opportunity cost eating into the price or the valuation of the property companies. So inflation is negative in the short term, but it is quite positive in the medium to long term. Call it moderate inflation. Why is that? Is because rentals are inflationary linked. So in time, if there's higher inflation, you'll get higher rentals or higher cash flows. So short term, you'll have some valuation pressures, but in the long term, it will actually be somewhat supportive to cash flows. But in the short term, and again, that's the benefit of looking at this global market, because you have certain sectors that actually react positively. Those with very short rental cycles, for example, hotels. Hotels, it's really a daily rate. So if inflation spikes, you have the ability to push your rentals in the short term. Whereas, call it healthcare, for example, if you have a long lease with a hospital, you can't really adjust that because inflation is increasing in the short term. But there are certain sectors, such as, call it hotels, that will benefit in the short term from inflation.
And lastly, a question to both of you. Why Sesfikile and why the Curate Flexible Property Fund?
I would love to say our skill set, but we believe that there are a lot of smart people out there, and we do our real utmost to keep up with them. But the truth of the matter is we have depth and breadth. We have the most depth with regards to years experience in the markets compared to anyone else in this country, and also globally as well. We really have a lot of depth in in this space. Call it on average in our investment team, there's probably the fund managers here about 20 years experience, global and local markets, as the PMs of this particular fund. And the breadth is that we have, call it 6 investment professionals just looking at property globally and locally as well. So we have that experience in the market. But I think the most credible driver here is that it's our business. The founders of the business are still very much here, as well as the fact that all the investment professionals are incentivized by earnings of the company. So we're here for the long term. We're not here to have a one-hit wonder. We're here, our name is everything, our brand is everything. And I think that our alignment to our performance is really what makes the biggest difference.
Right. The Curate Fund offers investors what we think is a nice blend of local and global property, taken away from investors the need to keep on monitoring the global and offshore and local exposure. We look at that exposure on a daily basis. We are nimble enough to change the fund if the conditions need. And I think our specialist approach to listed property allows us the skill set to identify those opportunities in the market. Evan touched on earlier how the global market offers specialization and is exposed mainly to developed markets, whereas in the local market is more of an emerging market feel. And those two, I think, complement each other quite nicely to create a listed property product suitable for different economic cycles.
Thank you, Evan and Naeem, for an engaging and insightful discussion. One of the key takeaways is that global property offers South African investors access to a diverse range of opportunities, with different sectors and regions behaving differently at various stages of the economic cycle. It is therefore important not to paint property with one broad brushstroke. A key advantage of the Curate Momentum Flexible Property Fund is its ability to invest across both local and global property markets. In fact, it is one of only a handful of South African funds that has this flexibility. This broader mandate allows investors to access attractive opportunities that are not readily available in the local market, such as data centers, while benefiting from diversification across sectors and geographies. The fund has consistently outperformed its blended local and global property benchmark, and it is well suited to clients seeking to incorporate specialist property into their portfolios. Next up is John Donnelly, an equity analyst covering the technology sector at Jennison. John, thank you for joining us from California and for sharing your expertise with our audience today. Let's dive straight into our first question. AI continues to dominate investor attention. Some commentators have drawn parallels between today's AI excitement and previous periods of market exuberance, such as the dot-com era. Do you believe AI is the next tech bubble, or what makes this cycle different from past technology booms?
While the comparisons to the dot-com bubble are logical, we believe that the AI era is going to evolve very differently, and those comparisons will be misguided. There's a few reasons for that. The first is the total addressable market for AI is going to be far greater than the internet. With the internet, it was a game-changing technology that allowed humans to take action and do work. Whereas in the AI ecosystem, we're harnessing all of collective human intelligence, and agents will be doing work for humans, which produces massive productivity gains. And we're just at the beginning of that cycle. Also, the monetization path of the internet followed a very different evolution. The attitude was build it and they will come. We spent a lot of money on CapEx ahead of demand for internet products and services. For example, in 2000, the top internet companies produced around $10 billion in revenue. Those were AOL, eBay, Amazon, whereas they spent $1 trillion in CapEx to produce that revenue. If we look at the numbers on AI today, AI is also already producing $300 billion in revenue, but we've spent the same $1 trillion in CapEx. So the numbers look completely different. The third important distinction is on the funding of the internet versus AI. The internet build-out was funded almost primarily by debt financing, whereas AI has been funded by the cash flows of the greatest companies on earth, which are all AAA rated credits.
Thank you, John. And what are the biggest risks to your AI investment thesis? What indicators would you monitor that would persuade you that this investment case remains intact?
The biggest risk to the AI thesis is that product innovation slows, demand for AI products stalls, and the data center build out comes to a screeching halt. We don't see that any indications of that happening today, as product innovation is just taking off. It's in the very early stages of that. You can see it in the use cases that are evolving. Coding is already a real use case, driving a tremendous amount of energy in the AI ecosystem. We have future use cases that haven't even begun to ramp, such as customer service, commerce, advertising, and breakthroughs in healthcare.
Thanks, John. One of the portfolio managers of the Curate Global Growth Equity Fund, Tom Davis, recently noted that mega IPOs such as OpenAI, Anthropic, and SpaceX could become some of the most significant market events in years, given their rapid index inclusion and the substantial passive inflows that may follow. How does Jennison strategically prepare for these types of events? And maybe you could explain a little bit of your rationale behind including SpaceX into the portfolio.
We're extremely excited about the IPO pipeline with OpenAI, Anthropic, and SpaceX just going public. At Jennison, we feel like we really have a competitive edge from a few angles. We have a 360 view of the entire ecosystem, from the data center build out to the AI applications that are proliferating in the market now. We have deep domain expertise in these areas. Jennison has a long history of investing in the most innovative growth companies. We have the scale, the relationships, the network, and we're truly global, so we can connect the data points around the world. That competitive advantage gives us a deep research edge. For example, when ChatGPT was first released, within weeks of that release, our firm was on the phone with Sam Altman talking through the potential for AI. We meet with Anthropic many, many times leading up to this IPO. We have a deep understanding of the company, what they're trying to accomplish, and what the roadmap actually looks like. Those relationships are invaluable. When we think about the individual IPOs, they're all exciting in their own ways. Anthropic is the fastest growing company in the history of the world. That is not a hyperbole. They have ramped in 3 years from $0 to $60 billion in revenue, and we think they're going to be doing over $100 billion in revenue by the end of 26. That is staggering. OpenAI is in a similar camp in that they are doing over $40 billion in revenue. And we also think they have the potential in the next 12 months to be over $100 billion in revenue. Those are huge, huge numbers. And it took other technology companies, the largest in the world, decades to produce that type of output. When it comes to Anthropic, they're specifically focused on the enterprise exclusively, which is doing work for companies and allowing companies to accomplish things that they could never do before in a much more efficient and clean way. OpenAI has taken a different approach, which is that they want toeholds in both the consumer market with ChatGPT subscriptions and the enterprise market with coding agents and other AI applications. So the companies are going after similar markets with a different DNA. SpaceX is the most exciting new IPO we've seen in a long time. The reason we decided to participate in the IPO is multiple fold. Number one, our investment process centers on trying to find the most unique companies that are almost impossible to replicate. SpaceX certainly fits this criteria. They are the leader in two of the largest emerging markets we've ever seen, space and AI. In space, they've accomplished engineering feats that are truly incredible, which is they have been able to put rockets into space faster, cheaper, and more reliably than ever in history. Those engineering feats are incredibly difficult. They now own 80% of the share of the space economy. There is no competition that can catch up to them within the next decade. Their lead is almost insurmountable. When it comes to AI, it's self-reinforcing with the space ecosystem. They're a leader in AI data centers. They've built all their own data centers, and they're at the bleeding edge of technology. We believe that that ultimately will translate into their long-term goal, which is to move data centers into space. We think this is a realistic goal based on engineering that they have today, and we think this value creation opportunity will eventually emerge and be reality.
Certainly very interesting and topical. Another question. Many investors think of AI as a narrow investment theme dominated by NVIDIA and the hyperscalers. Where are you currently finding less obvious opportunities across the AI value chain?
NVIDIA is an incredible company, and they kicked off this amazing AI wave. However, it's not the only way to invest in AI today. We believe that the data center build-out is multi-year with long duration. There'll be trillions and trillions of dollars spent on these data centers, and they all face unique challenges. Right now, the demand for AI products far outstrips the demand for compute produced by data centers. Inside the data centers, we found many opportunities that are hidden unless you dig deeper. A few of those opportunities are the tools that have to make the chips that go into data center, the liquid cooling that has to be provided, the networking equipment that makes AI possible, and the memory that stores AI. But we think one of the biggest bottlenecks and one of the most important themes is power generation. The electrical grid cannot physically keep up with the demand for AI. To solve that problem, we found a number of companies that are truly revolutionary. One of them is Bloom Energy. Bloom Energy has produced fuel cells that connect directly to an AI data center. They do not need to connect to the electrical grid at all, therefore producing AI power without being constrained by the time it takes to build out the grid. We think that power behind the meter, behind the electrical meter, is one of the bigger themes over the coming years.
That's interesting. Thanks, John. Finally, the last question. If you were speaking directly to long-term investors who are concerned that they may have already missed the AI opportunity, what would your message be?
We are at the very, very beginning of the AI investment opportunity. There are so many new markets that are going to be created by AI. Right now, the reality is there's really only a few use cases that people are engaged in today. Coding is a tremendous one that has taken off, and it is accelerating at a very high rate. However, the biggest markets in the world, such as the consumer, hasn't even been addressed by AI yet. The opportunity in commerce is incredible. Advertising will eventually be taken over by AI and revolutionized. Healthcare is one of the biggest markets in the world. The products that will come out around drug discovery, research, and care will be mind-blowing. We're just at the beginning of the agentic application age. That just started. As of today, we've really only been able to invest in the data center build-out. We're incredibly excited about what the agentic world will offer from an investment perspective.
Thank you once again, John. Truly a fascinating perspective on the evolving growth and technology landscape. What really stood out was how AI continues to drive a new wave of innovation, not just within technology, but across industries more broadly, and the discussion around IPO activity was particularly interesting and certainly very topical. If I now move briefly onto the Curate Global Growth Equity Fund. The strategy invests in companies with the ability to benefit from long-term structural growth trends, like the examples we just discussed. While growth investing has experienced periods of volatility, the opportunity set remains compelling, especially for companies driving innovation, sitting at the center of supply chain bottlenecks, and capturing new market opportunities. This makes the fund particularly well-suited for investors looking to capture global growth opportunities within a diversified portfolio. To close today's session, we are joined by John Mullins from Lyrical Asset Management, who will explain why some of the market's most overlooked companies can be among the most rewarding in terms of investments.
Thank you, Ali. My name is John Mullins, and I'm a portfolio manager at Lyrical Asset Management, and I'm a lead PM on the Curate Global Value Equity Fund. And today, I want to talk to you about boring things, because boring investments, we've found, are a good way to make a lot of money. Now, in today's market, most people are obsessed with exciting AI-related stocks, but we think some of the most attractive returns to be found in the market are hiding out in some of its most boring places. Over the next 15 minutes, I'll show you why we love some boring businesses, distributors, the middlemen of the global economy. Everyone wants to talk about the exciting stocks in the market, and today nothing is more exciting than AI. At times, it can feel as if the entire market has been split into AI winners and AI losers. And we see that here on this slide. On the left side, you can see the semiconductor index, which is the poster child for AI beneficiaries. That's up 89% year to date, while software companies, which are considered to be AI losers, are down 14%. Now, both of these groups are exciting, and having a view on them can make you popular at the next cocktail party you attend. But can you effectively bet on either of them? Let's look at semis. There's a lot of AI-driven growth in semis to get excited about. But as we see on the right side of this slide, they trade expensively at 28 times forward earnings. And then there's the other problem with semiconductors, which is that because of supply shortages, their margins are much higher today than they have been historically. So it's easy to see a version of the world where betting on semis from here is a great bet. But it's also easy to see a world in which those margins revert back to normal levels and multiples collapse. What about software? Well, in the software sector, we have some companies that have previously been considered some of the best companies to ever have existed in the world. And now some of them are on sale, having gone down this year. But as you can see on the right side, these companies are still not cheap. They trade more expensively overall than the market. And can you really figure out what the future of software is in an AI world? If you think about what we do, investing, as playing a game, we would say that investing in AI winners or in AI losers today is a hard game to win. After all, most investors in the world are digging in on just these topics and placing their bets on these exciting areas in the market. And a game that has more players is harder to win. In the Curate Global Value Equity Fund, we prefer to play games that are easy to win. And to do so, we focus on areas of the market where others ignore it, where there are fewer players to compete against this. As an example of this, in our fund, we own distribution companies. And if we look at this slide now, we've added a new line. In green, we add the distribution stocks that we own in the Curate fund. These stocks make up about 10% of the portfolio. Now, perhaps surprisingly, these stocks, which are quite boring, are doing quite well this year. They're up 41% year to date, or more than 4 times the return of the MSCI World. But as we can see on the right side of this slide, these companies are very cheap at 14.5 times forward earnings. If we consider this a game, the price to entry here, the price of admission to play this one, is much lower than investing in semiconductors or in software stocks. These stocks trade at a 25% discount to the market and a 50% discount to the semiconductor index. And that's the message today. Boring businesses and easy games, they can deliver exciting returns. So what are these boring stocks? They're distributors, the middlemen of the global economy. They each work with thousands of manufacturers to buy and then deliver their product to hundreds of thousands of customers. And on each side, they add significant value. For manufacturers, our distributors act as an outsourced sales force and marketing arm. Consider, for example, Rexel, which we own in France. This is an electrical distribution company. And they help small electricians buy the products that they need to do their work every day. So a small electrician will show up at a Rexel branch and buy the switches that they need from Schneider on their way to work. Schneider doesn't want to own that relationship with that customer, and they certainly don't want to have to get in a van and drive to that customer's worksite hours later when that customer needs a refill in product. On the customer side, distributors also add a significant amount of value, this time by getting them better prices and delivering to them much better service. Consider, for example, the case of Brenntag, a chemical distributor. If you were an owner of a craft brewer that needed to have food grade acid to clean out your tanks in between brewing different batches of beer, you wouldn't be able to call up Dow Chemical and get that chemical that you need in order to do the work. So you call Brenntag instead. Brenntag can use their massive scale to get that product to you for a much cheaper price. And instead of delivering it to you in a full rail car's worth of it, they can bring it to you in a small container just in time for when you need it. In total, as you see on this slide, we own 6 of the world's best distributors. And we think owning these distributors is akin to playing an easy game. Each is the number 1 or number 2 player in their niche, and they earn high returns on capital because they have a significant scale. They're highly resilient, and we don't think that you need to have a view on AI to make investments in any of these companies. But before we go too deeply into these stocks, let's take a step back. Because one of the most exciting things we find in these boring businesses is their valuation. They trade very cheaply relative to the market. But why does that matter? Well, it matters very much for what you see on this slide. Cheap stocks deliver excellent returns over time. What we're seeing here is that the cheapest 20% of companies have outperformed global markets by more than 5% per year going back to the 70s. Value is the most enduring source of alpha in markets. And that is why when we purchase stocks in our fund, we only select them from amongst the cheapest 20% of stocks in the world. But there's one really important distinction to make here, which is that top line, these companies that have delivered exceptional returns over time, they've done so in spite of the fundamentals. Value works on average because nobody wants to own a bad business. The stocks in that top line, on average, they've undergrown the market by 2 to 3% per year on an earnings basis. They have worse balance sheets, worse returns on capital, worse management teams. Nobody wants to own a bad business, so those stocks become too cheap and then they re-rate later on. That's why value works on average. In our fund, we try to do something differently. We believe that hiding out in that top line are some pretty good companies. And if we're diligent, we believe that we can find them. How do we do that? Well, as you can see here, we follow a disciplined investment process. We call it value, quality, and analyzability, or VQA. On the left, value, that's pretty obvious. As I said already, we only buy stocks from amongst the cheapest ones in the market. But what about quality and analyzability? Well, quality for us means we want to buy reasonably good businesses. We don't think we'll ever own the best companies in the world, but that's okay. We want to own businesses that can sustainably generate double-digit returns on capital by having a real and sustainable economic moat around their business that can allow them to reinvest at those higher rates of return and drive good earnings growth. We also look for analyzability. What that means is keep it simple. In other words, play games that are easy to win. We value businesses based on their long-term earnings power. If we can't tell you reasonably what that is, the game for us is too hard to play. We'll look for something else. Now, as you'll see now, the distributors that we've talked about clear all 3 hurdles quite clearly. Let's start with quality. Do our distributors have the quality that we look for when it comes to VQA? Well, we think so. Just look at the top left on this slide here. Our 6 distributors have earned 20% returns on capital for a decade. And what's really interesting is if you look at the bottom left, they earn such great returns while using very little capital in total. Their CapEx to revenue is less than 1%, which compares to the MSCI world at about 5%. And the reason that they can generate these returns is very simple. It's scale. Because they sit between thousands of manufacturers and hundreds of thousands of customers, they're able to negotiate with those manufacturers and drive prices down. And that allows them to generate those returns quite a bit above smaller players very, very consistently. And now, importantly, this is a moat, this scale-driven moat. It shouldn't be impacted by AI in any type of negative way. A smaller distributor can't use AI to all of a sudden gain the scale that they need to compete with a Rexel or with a Brenntag. In fact, we think AI will likely be a beneficiary of these companies because with their scale and with their balance sheets and with their cash flow, they're actually able to invest in AI and give them more of an advantage relative to their smaller peers. Now, one thing I will point out on this slide is if we look at the bottom right, leverage is one of the key components we think about when we think about owning quality companies. And our distributors have more leverage than the average company in the market at about 2.4 times net debt to EBITDA relative to the MSCI world at 1.3 turns. But we're very comfortable with that level of leverage. And the reason is what we'll see on the next slide, which is that these companies are incredibly resilient. As we see here, this is the magic of distribution companies, and it's what makes them so analyzable. Counter-cyclical cash flows. We saw before how these businesses are very capital light. Well, distribution companies, the biggest asset that they have on their balance sheet is inventory. Because what they do is they buy product from a manufacturer and they hold that inventory typically for about 2 months before selling it on to the end customer. Now, this is very important because what happens at a distribution company is when sales slow down, like in a recession, as we see here, the company stops buying new inventory and they run down their current inventory balance. And what that means is as sales slow down, free cash flows actually go up. Consider this on the left side of this slide. Our distribution companies, their free cash flows in the global financial crisis went up by about 40%, while cash flows for the overall market fell precipitously. This makes these companies incredibly resilient because they are bulletproof in recessions. Rather than be worried about them when a recession comes, we're actually excited about them because they're generating more and more cash. And that can allow them to play offense in a challenging period. For example, they can take that excess free cash flow and they can go and they can buy smaller companies and actually add to their moat that is scale driven. Now, this is something that might sound boring to others, but to us is incredibly exciting. And as we move on to the next slide here, we can see that putting it all together, value, quality, and analyzability gives you something that's very uncommon, which is a combination of value and growth. Here we see 3 charts. At the top is the total return, in the middle is the earnings per share, and at the bottom we have the valuations or the PE multiples. Here we compare our 6 distribution companies versus the growthiest index in the world, the S&P 500. As you can see in the middle, our distribution companies have compounded their earnings at an 8.9% rate going back to 2007. That's faster than the S&P 500's growth at 7.1%. And yet, these companies trade today for only 14.7 times earnings, as we've discussed, versus 21.5 for the S&P 500. That's a third of a discount for companies that are actually growing faster than the market. Now let's dig in a bit more to 2 of our distributors. They may both be boring, but one of them does have an exciting AI-related story. The other one is just boring. Not only is it a boring distribution company, but they serve a very boring end market, which is the dental market. First up here we see TD SYNNEX, a leading global IT distributor. They act as a middleman connecting hundreds of tech vendors to 150,000 or so tech resellers across 100 countries. For tech vendors, they're an outsourced sales force, a way to connect with so many resellers. And for customers, not only do they provide the best price, they also offer things like financing and service. They can help you actually install these technology products and manage them. So how does it look on VQA? Well, let's start with valuation. As we can see here, this is a pretty growthy company. TD SYNNEX has grown its earnings at a near 16% rate going back to 2007. That's more than double the S&P 500 growth over that same period of time. What about the valuation? Well, it trades for only 14.7 times earnings, a significant discount to the market for double the growth. But what about quality and analyzability? Let's start with quality on the left. We see that returns on capital for TD SYNNEX have grown from an already high 20% to nearly 30% over time. And that comes as the business builds more and more scale. It's widening its moat over time. But what about analyzability? Can we predict it? Well, we think we can. Look at the right side of this slide, which shows 2 decades of steady growth in revenue per share and margins that have been very steady, including through recessions. Now, one thing I'll point out here when it comes to analyzability for a tech distributor is one key risk would be obsolescence, because what TD SYNNEX is doing is they're acquiring technology inventory and they sit with it for a little bit before they sell it on. And so obviously they could be at risk if these technology products become obsolete, if there's a newer thing that comes into the market. But in this case, we're actually protected. And the reason for that is that on the vast majority of its inventory, TD SYNNEX has either price guarantees or return rights on that inventory, which really means, interestingly, the biggest asset that TD SYNNEX has is its inventory, and most of that inventory doesn't really carry risk to TD SYNNEX. The risk remains with the vendor, which also just goes to show you how powerful the business is in its ecosystem. Now, I mentioned this is a company that has some excitement to it. There is an AI kicker here. It's called Hive. About 30% of TD SYNNEX's business it provides distribution and design to data centers that are being built out by hyperscalers. This is a fast-growing part of the business, and it is quite exciting. But the main thing I would point out from our point of view is that you don't have to pay for that excitement when you're trading a mid-teens PE multiple for a stock. And so as excited as we are about the data center distribution business, we don't think that you need to have continued outsized growth to get excited about this stock. Now, finally, let's talk the most boring of the boring, the dental market and Henry Schein. Henry Schein is the #1 dental distribution company in the world with a 40% market share in the US. 90% of dental practices in the US are a customer of Schein for something. If a dentist's chair breaks, typically that dentist is calling Schein and they will be there that day to fix it. And Schein does more than just provide products. They're the largest provider of software into the dental industry. And so it's likely that your dentist is actually using Schein software to put in an insurance claim or to manage your appointments. It makes them truly a very sticky business. As you can see on this slide, it's a company that's outgrown the S&P 500 going back to 2007 with 8.9% earnings growth per year. Not only has it grown faster than the S&P 500, it's very recession resistant, and revenue grew right through 2009. How does it look on valuation? Well, only 13.7 times earnings for a high single-digit earnings grower. That looks pretty exciting to us. Now, Schein also is a high-quality business, and we see that here on the left with 20% returns on capital. It is the dominant scale player, and that allows Henry Schein to earn margins that are about 50% higher than the next largest player, which just goes to show you how important having that scale negotiating leverage really is. And as for analyzability, as we see on the right, this is a company that for 2 decades has delivered a steady 5% revenue growth with margins very steady over time. This may be a boring business, but it's one also that has non-deferrable revenue. Even in a recession, if you need a cavity filled, you typically get that done pretty quickly. And that allows Schein to grow revenues, as we see here, through recessions. Now, Schein may be a boring business to many others, but to us, having a 9% earnings grower that's recession resistant, that's quite exciting as far as we're concerned. As we come to a close, from Shine to Cinex, we've seen how boring companies can deliver exciting returns. We'll leave the exciting stocks and the harder games to everyone else. We'll stick to the boring companies and the easy games, all in an effort to deliver exceptional returns to our investors. Thank you very much.
Thank you, John. What stands out about Lyrical's VQA approach is the belief that the strongest performers over time are not the most exciting or headline-grabbing businesses. As you heard, Lyrical's philosophy offers an interesting contrast to the views shared by Jennison earlier. While markets today are heavily focused on AI and high growth opportunities, Lyrical reminds us that attractive long-term returns can also be found in businesses that are often overlooked. The discussion highlighted that valuation matters, and that buying high-quality businesses at attractive prices remains a powerful driver of long-term investment success. To summarize, the Curate Global Value Equity Fund, the portfolio aims to deliver long-term capital growth by investing in companies that are undervalued relative to their true worth. This approach provides a strong complement to growth and quality strategies, helping investors achieve a more balanced and diversified outcome. That concludes our Exhibiting Our Investment Artists webinar. We appreciate you taking the time to join us today and hope you found the session insightful and thought-provoking. Please remember to complete the event survey, as your feedback plays an important role in shaping future events and content. If you have any further questions following today's session, please feel free to reach out to your Curate Fund specialist. Thank you again for joining us, and from all of us at Curate Investments, goodbye.